Hello, good day. My name is Nenanik Obiebo, and today I'll be your host on Business Pulse with Preston Pedabo. And with me, I have my two exceptional colleagues, Mr. Ahmed Majolagbe, who is a senior associate transfer pricing unit, and Mr. Favor Naji, who is the assistant manager transfer pricing unit. Welcome. So today they'll be sharing insights on transfer pricing, taxing the intangibles, and the real costs of intra-group services in Nigeria. So first of all, I would like to ask you, Mr. Ahmed, what exactly are intangibles and what are intra-group services, and why do they pose a key or rather unique challenge for tax authorities like the FIRS?
Okay, so thank you for having me. It's a pleasure to be with you on this session. So, before we delve into what intangibles and intergroup services really means, I would just like to brush through what transfer pricing is. So, transfer pricing, in a short form, is a mechanism of setting prices among the related entities. By related entities, I mean that the mechanism of setting prices between one entity in a multinational group, in a group of companies and the other entities, both under a group of companies. So that mechanism of setting prices is what transfer pricing is all about. So we'll now look at transfer pricing. The scope of transfer pricing covers a lot of things, of which is intra-group services
Yeah.
and the intangibles, right? So when we talk of intra-group services, these are services that are being provided by an entity within a group of companies to another entity under the same in the same group of companies, right? For instance, you have one entity providing management support service, one group entity providing IT support to the other entity, marketing expertise, services in general. All right.
And sometimes they might be. Sometimes I think they might also be under the same organization, but just different subsidiaries. Yeah.
The nature of this transfer pricing we're talking about is between entities under the same group of companies. I mean, when you have, for example, you have, let's say, for instance, you have Dangote, Dangote Industries, right? You have Dangote Cement, Dangote Flour, and Dangote Refinery, for instance, and they have the render services to each other. One render management support to the other, one marketing expertise to the other. The other again does IT support functions to the other. So those functions, marketing, management, and IT and the likes, are what we call intra-group services. So it happens between from entity to another entity under the same group. Understand? So on the other hand, intangibles. Uh, from the name intangible is something that is not physical. You can't see them, you can't touch. You understand? So according to OECD, OECD quickly describing intangibles as something that is not physical or a financial asset, but which has the capacity to be owned or to be used for commercial activities. You understand? So now going into what really makes it
An intangible.
problematic. Let me just use that word, problematic for tax authorities is the fact that intra-group services and intangibles are both inherently subjective, right? You can't from looking at it from afar, you can't really tell that okay, this is intangible, this is what it values. This services, this is unlike a tangible product. When you see a machinery, you know that okay, from the market dynamics, you know this is how much you're selling it, all right. But services, it's very difficult for you to just say, okay, this particular management service, it is 100,000 naira. What you know is very subjective, so that's difficult. So with that difficulty, it now creates tools, right? Tools for eroding the tax base of a particular country, particular tax jurisdiction. Let's say for Nigeria, instance, the management, because it's very subjective, you can't really say this particular amount is what you charge for management service. Now it now creates an avenue for eroding the tax base in such a way that other companies, other related entities in other jurisdiction might use that to like reduce their taxable profit in Nigeria, and then take that taxable profit over to the other jurisdiction where they might have a lower tax rate. Understand? So the same thing for management also. Management service, for instance, if you want to reduce the taxable this thing in Nigeria, you might decide to charge higher to reduce the taxable profits in Nigeria and then take the profit over there where the tax has been lower. Understand? So this is intra-group services and intangibles are both very, very unique, and because of their unique nature, it's kind of problematic in valuing them, and it gives a great problem to the tax authorities. That is why there are some steps that have been taken in ensuring that they are accurately capturing the transfer price and ensure that the related entities involved or concerned actually pay fair share of their taxes.
Oh, thank you
I would
so
like
much.
to-
Yeah.
So I'd like to add one more thing to what he said. Intra-group services also could be um, services rendered, like he said, between an entity to other entities within the group, or maybe it could be just one entity, but it's usually within a group. So maybe group of companies. You could have companies that have a structure where you have a holding company and all of that. And then to talk about intangible, buttressing what he said, intangible is a non-physical asset, but it has a commercial value.
Yeah.
So, for example, maybe the patent, trademark, software license. That's an example of an intangible. So one of the issues that the FRS, why it has become, a challenge where the FRS begins to question is because, like you said, some of them are hard to value. So, placing a value to an intangible asset. So, the key point as to what the FRS would usually look out for, for these two services would be, establishing that this service was actually rendered. That's one thing. So, anybody can come up and say, I rendered this, I provided this. But, that verification that has it been rendered, then the second leg they will look at, of what benefit was it to the service recipient. In this case, this is a Nigerian entity. As they receive this service, has it had any improvement in the operational efficiency? Did it affect their profit margins? And all of that. And then, so those two do come into play, where they ask, establishing whether it was done, did they actually receive this service? And of course, the last part would be in documenting evidence for you to say, okay, this is what, to back it up and prove.
So some of the things you mentioned are now the key substances, right?
Yes.
Okay, thank you so much, Mr. Favor. So I would like to also ask what are the most common red flags that make a charge for an intra-group service? So what are the common red flags?
So the common red flags we have is in some cases, first of all, like I mentioned earlier, the FRS trying to determine, the benefit test, which is did they actually benefit from it?
Yeah.
That's the service recipient, and then was it provided? And then so there are some other things we'll look into, where they look out into the services that were actually provided. Was there a duplication? So you can have a situation whereby you have they look into the functions. Was it a duplicated service? An example would be a company could come up with management services, and within the management service you could see IT, accounting, HR, human resource. And then you're also seeing that maybe they are also paying a third party, for the same IT service. So those are the red flags that we look at. The second one will be maybe shareholder activities. So for companies that are within a group, you find out that maybe for the holding company, there's board meetings and payment of directors for the meetings, and all of that. It's of benefit to the shareholding, to the holding company, but not necessarily to the Nigerian entity. It's not, the FRS will look at it and say, you shouldn't charge to the other entity. Those are the things you look out for. The other one would be maybe arbitrary allocation, whereby there's no substantiated cost. Like they're not able to quantify, okay, this is why we charge this. This is the basis on which we charge this. So those are the things you look at, when it's just an arbitrary cost allocated and you're just saying, oh, there's no agreement in place, there's no basis. Maybe you just say this entity you're paying so amount for this. So those are the red flags.
Well, thank you so much. Thank you so much, Mr. Favor. So, Mr. Ahmed, would you like to add anything to what your colleague has said?
Just to add a little to what you just said,
Mm.
I mean, it's I said it all, just to compliment what you just said. Part of the red flag to watch out for is, documentary evidences,
Mm.
right? For every transaction,
Mm.
documentary evidence is very, very key. You
Mm.
understand? So, there's need for you to keep documentary evidences.
Mm.
Evidences like invoices,
Mm.
service level agreements, and even emails, right? That would document that, okay, these transactions was actually uh, carried out. Okay. Otherwise, it might be construed that such transactions are fictitious.
Mm.
Okay. All right.
Thank you, Mr. Ahmed. So, beyond just setting a price, what are the key elements, or rather, what are the key elements of substance that the FIRS looks for to validate an intragroup service? I mean, he has already mentioned a couple of them.
Okay, so in validating the intra-group services with regards to the substance I just mentioned, talking about substance simply means that um, the reality, it means the reality as against what you agree, right? So, but in transfer pricing, ordinarily, your agreement in principle should mirror the reality, what the business actually done,
Okay.
right? So what you agreed in your agreement and what you actually carried out should mirror each other. However, where there's discrepancy between the two, that is where the substance comes in, right? They will have to go with um, what the business actually carry out in reality than what you agreed in principle. And in doing that, in testing the substance of intra-group services, um, basically the tax authority will just carry a benefit test as well as the test substance. You want to test the originality of that transaction of the Intra-Group services. And in doing the benefit test, it's just like when you carry a benefit test, it's simply that you're asking questions, just three basic questions when you carry out the benefit test in determining the substance of the transaction, right? So the first one is the services you are talking about are were they really rendered, were they provided, right? So if for you to defend the fact that the services were provided, you bring documentary evidence, just like we have said earlier, the invoices and the receipts and agreement and everything that would show that you actually carried out that transaction, you provided the service, right? So the second question is that the service that was provided, was it really needed? It's one thing for you to provide the service. It's another thing for me to need that service that you provided to me, right? If I don't need the service you are providing, why are you providing it? It means that maybe there's something you understand.
Mm.
Something is okay. So the second question is, was it really needed? So that questions will be answered. So okay, in answering that question, right, the tax authority will then look at, okay, would the service recipient, would the service recipient approached an independent party, that is a third party, unrelated entity, right? That is outsider, just to put in layman form, outsider, right? Would the service recipient approach the outsider to receive such services or not? Right? If the service recipient ordinarily would have approached outsider to the source of services, then they would construe it to be a needed service, right? Then the third one is the price charged for the service. Where was it within the arm's length, right? Was it ordinarily would it have been charged among unrelated entities outside the entities within the group?
Yeah.
Do you understand? So
Yeah.
those three questions form the benefit test that will be tested to confirm the substance of that transaction.
Okay. Thank you so much, Ahmed, for explaining in detail. Based on everything you've said, what would you say are the direct financial consequences a company would face when the FIRS discovers that this intra-group service arrangement has violated transfer pricing rules? Are there financial?
Yes. So the financial consequence for every company in Nigeria for violating the intragroup services, or hold up, let me just say for violating the provision of the Income Tax Transfer Price Regulation 2018 um, is you know 10 million, 10 million, and then 10,000 for every every day the default continues. That is transfer pricing filings. But however, when it comes to transfer pricing documentation, it is 10 million or 1% of the value of the transfer, the control transaction, you see, the transaction. I mean, we call it control transactions. The other is the terminology in transfer pricing. Control transaction between related entities. So when you see that, okay, you have carried out transaction, intra-group transaction that was not supposed to be carried out, so the penalty will then be 10 million or 1% of that value of the transaction, whichever that is higher.
Interesting.
Yeah, so I would like to add to that.
Mm.
So for financial implication for most companies would be, like he said, the penalties. The second one would be the total cost for that service will be disallowed in
Okay.
its entirety, just depending on how the client is able to, prove beyond reasonable doubt that, as part of that benefit test, they've received this service, it was a benefit, there's improvement in the operations, and then lastly that, it's something that, an unrelated party will be willing to pay for, to receive that same service. So the total cost for that transaction, or maybe a percentage of it, could be disallowed. Then there's also the part of interest and penalty for defaulting, that not meeting the timeline for the filing of the TP returns, the TP documentation, like you mentioned. And then the third part would be issue of double taxation. Because you have it that the other entity, the service recipient, has put it as a cost to them, of which has been disallowed in its jurisdiction. And then the other entity has recorded it as an income and has been taxed in the other jurisdiction. So those are the, issues that could come up where even the service provider, has been taxed and the other one is disallowed. So it could increase the financial burden of the company as a result of not having to, price accurately, like you mentioned earlier, and not being able to prove beyond reasonable doubt that this service was received and it was, it was even at a price that, a fair price.
So thank you so much, Ahmed, and thank you so much, Favor. So for the final question, what would you say is the most proactive step or the critical step that a Nigerian entity can take to ensure that their intergroup service agreements is defensible?
Okay. Thank you for that question. I'll couch it as proactive transparency, because they go hand in hand, so the company has to be proactive and you have to be transparent. So in most cases for transfer pricing, most companies, usually see it as, they're not necessarily, they usually think it's like the regular taxes where you have to make payments and all of that. But one of the major things about transfer pricing is compliance and disclosure. That's the transparency. So one of the proactive measures they can take to avoid transfer pricing adjustments or TP audit exposures would be to have, documentary evidence. In this case, you have the first one would be intercompany agreements. So you have an arrangement or a service being provided by one of your entities within the group. It's important that you have an intercompany agreement to document these transactions, to accurately indicate the services and the functions performed by both entities. Where it highlights that effectively. The second one would be because at the end of the day, the onus is on the client to prove beyond reasonable doubt that this this transaction held, and you'll be able to price accordingly. The second one would be to besides the intercompany agreement, which is the first step, is to have documentary evidence. So where you have maybe time logs, as the case may be, you have email correspondence to evidence those things, invoices, between both related parties, meeting notes. You have those documentary evidence to prove that, okay, this is what we did, this is how we're able to account for the cost, this is how we're able to arrive at the cost. So those ones are very important. And then lastly, for me, would be the transfer pricing documentation.
Mm.
So that's being proactive, and then having to tell your story, as to where it started from, the functions performed, the assets, the risks. You're documenting, you're telling that story as to this is how, I'm either the service provider or the service recipient. And then pricing, of course, in the documentation, you have the proper pricing method which you have used. So long as you're able to tell these stories and back it up with your, agreements, and it's not different from what you're actually doing. That's where the substance which you described earlier, is not different from what you have documented, and you have also priced accordingly. So you're basically you're more likely, very compliant. Once your story they match up, you're able to prove beyond reasonable doubt that this service that was carried out, then you're good to go. You basically do not have any issues with the FRS. So it will now be a case of what could likely come up will be a case of the pricing terminology. Was it priced right? That would be discussion that would be, because transfer pricing in itself is very subjective. Yeah. So that's it.
Thank you so much, Ahmed and Favor, for coming on this podcast today. So the bottom line of everything my colleagues have said is that do not let intra-group service agreements be your biggest tax liability. Ensure you document everything, price fairly, so that you can defend it to the FIRS. Thank you.